Okay, peeps, welcome back. So today we're going to be talking about how to retire on the Defiance ETF JEPY or JEPY. It's not to be mistaken with JEPI, the JP Morgan covered call ETF, with $5,000 a month and fire your boss and retire for good. So let's get it. Now, the first thing that I want to bring up is that I am in no way advocating just investing into one ETF, although I suppose if I was going to do it, this would probably be the one I would pick because, again, it's based on the S&P 500, a whole index, not a single stock. Not that there's anything wrong with single stocks, but you get diversity, you get diversification with an entire index. Us personally, we like to stay heavily diversified just because you never know, and we're still in uncertainty with not knowing if the Fed's going to cut. They're going to stay, higher for longer in terms of keeping rates high, or whether the market's going to go up, going to go down. So we kind of have to tread carefully. But for this particular point in time, we like to stay diversified, but we also do want to get passive income. So let's get it. So as you guys can see here on the charts, the Title Trust 2 Defiance S&P 500 Enhanced Options Income ETF, that's a mouthful. JEPY, you guys can see that this is the current price action. Not a lot of data here because it's only basically about a month, not even a month old actually. We had a little dip here. This was probably due to the dividend payout. That's pretty much to be expected, but understand that the S&P 500 goes up 66% of the time and only 33% of the time it goes down. The markets usually, the traditional markets, not crypto, the stock markets usually go up for roughly about, I would say on average, somewhere between 10 to 15 years. The traditional markets are in a bull market, and once in a while you'll have like a 1 to 3 year bear market. That's usually how it goes. So as you can see, based on history, more often than not, it does end up going up versus going down. And as a matter of fact, before we get into the actual passive income piece, we're going to take a look at that right now. So the JEPY is based on the SPX or the S&P 500. SPX is not to be confused with the SPY. The SPY is an ETF. The SPX is the actual S&P 500. So just want to make that clear right now. But as you guys can see, basically, like if we really, really scroll out here, you guys can basically see that from 2009, pretty much all the way until 2020, we were pretty much going straight up. And then even during the Rona dump in 2020, we didn't really, we went down a lot. We went down lower than the 2018 lows, but we didn't go back all the way to the 2009 lows. So we were technically just going straight up. And then even after that, you guys can see that we really went on a huge run here. So this was the big bear market right here between December 21 and basically the bottom here at October 2022. That was the technical bear market. A bear market is defined as an index being 20% or greater down from its previous all-time highs. So that was technically a bear market. This was a bear market. Even though it was a black swan, doesn't really count, but it is technically speaking still a bear market. But as you guys can see, generally the trend is up more than it is down. So with that being said, let's get into our holdings. So as you guys can see, we currently only have one share of JEPY, but we have 12 shares of Triple QY. Why is that? Because Triple QY, we believe, is going to pay more than JEPY because the NASDAQ is more volatile than the S&P 500. If you understand trading and investing in the indexes, you understand how this works. We do have index funds within our retirement account that track these indexes. So we also trade the S&P 500 futures. So we have a pretty good idea of what the indexes look like and how they work in terms of volatility. But we do want to pick up some more JEPY. So here's the website with the Defiance ETFs. As you guys can see, the current distribution rate is 55.17%. We think this is actually going to be higher in November. As crazy as that sounds, we do actually think it's going to be higher. I'll explain why in a minute. So as you guys can see, the payment that we got this month was 90 cents per share. And keep in mind, these are monthly distributions, okay? These are not quarterly. For all of you who are new to the channel, these are monthly ETFs we're talking about here. As you can see here, distribution frequency monthly. So with that being said, the next X dividend date is the 1st. Basically what this means, the X date is essentially what that is it means that you have to, if you want to get paid a dividend from this particular ETF or anything you invest in with an X date, with the dividend, you have to hold the shares before the X date to actually get paid on the payable date. That's how that works. So the reason why we think it's going to pay more in the month of November than it did in the month of October, as you guys can see here, the inception date was on the 18th of September. If we go back down here, I got to find it real quick. We go back to JEPY. I'm going to scroll out to the daily so we can take a look at each day's trading. As you guys can see here, the first trading day that this thing had on the markets was on September 19th, which was on a Tuesday. If we go over to the calendar, you guys can see that basically the JEPY only traded for a full 9 trading days. So trading days are considered in the stock market to be Monday through Friday. Stock market is not open on the weekends, so you only get trading sessions Monday through Friday. It's different for futures and crypto, but for stocks, which this is listed on a stock exchange, it would be a little bit different. So we basically had 9 trading days here, so you get roughly about half of the entire month's worth of trading. So with that being said, it can basically be summarized that we pretty much only got 2 weeks worth of trading in September, which means that it's possible that this yield could actually be closer to 110% in November, because keep in mind, this month we're going to get a full 4 weeks, or actually 22 days of trading during the month of October. So could be looking potentially at 110% yield, and also maybe as much as, and don't quote me on this, I don't know this for sure, I'm just taking a look at the data with you guys to kind of figure out what it might be. Could be taking a look at as much as $1.80 per share, but in all honesty, if it was still only 90 cents, that's not really a bad deal. That's still like record-breaking yields right there. So let's get into how you could retire and fire your boss and kind of be done with the job scene if that's what you really want. So we have all our data here. This is on the marketbeat.com dividends calculator, JEPY. It's technically an ETF, but they have it listed as a stock here. So the distribution frequency is monthly. You'd be reinvesting the dividends. We start out with 53 shares, which basically in short is $1,000 divided by, as you can see here, $1,000 divided by the current share price of $18.92, which that is actually not accurate. So we got to change this to 1906. But it would roughly be about the same amount of shares, maybe like 51, 52 shares, something like that. I guess we'll go ahead and change it and say 51 shares. So hypothetically, you put in $500 a month. Here's your tax rate, which it's hard to say if it's qualified or non-qualified. We don't know yet, because it's a fund that's traded within the U.S., that's based in the U.S., but it's not technically a company. So we don't really know. We'll just have to wait and see during the next tax season. The current yield, which is 55.17%, and that's listed here on the website. If you check out our previous video on triple QY, you'll see the link for the Defiance ETFs, or you can just type in the website name here. It'll bring you to the website. 0 dividend increase, because we think that dividend's pretty high already. That likelihood of it going up's probably not likely. If it stayed flat, that'd be nice, right? Expected annual share price appreciation 1% per year, because again, the S&P 500 is going to go up every year. Historically speaking, based on historical data, we invest for 10 years. And these are the numbers you're looking at. So by year 7, you would be well over $5,000 a month. Actually, you would almost be there on year 6, truthfully. With a total account balance of about $164,000, with basically starting from $1,000, and that's if this is the only thing that you ever bought. You didn't want to diversify or anything like that. Now, if we go ahead and up the amount that we put in a little bit more. We'll say you put in $1,000 a month instead of 500. As you guys can see, it speeds up the timeline. You're now sitting at $5,000 a month in year 5 instead of year 6 to year 7 with an account balance of 185 grand. And once you get to year 6, you're actually well over that 6 figures every year. So that's definitely nice to see. So we'll go up a little bit more. We'll say 2,000 a month now instead of 1,000. And if we take a look at the numbers now, you're well over the 5,000 a month in year 4, $200,000 account balance. In year 5, you're actually sitting at 10K a month with a $360,000 account balance. So this is more or less the what you're looking at here is the compounding effect of dividends being reinvested. So basically, your dividends would buy your initial capital would buy shares, and then you would use your active income plus your passive income to buy more shares of the same thing, which would then compound on itself. Your money would grow because you're buying more shares with the money that you're getting paid, and then those dividends that you're getting paid by more shares, and it keeps growing on itself. It gets bigger and bigger and eventually self-sustaining. Now keep in mind, this is if everything stays the same, the dividend yield stays the same, the price stays the same. Obviously the price and the yield are going to fluctuate because these are covered calls. That's typically the way it works. Now in terms of share price appreciation, I don't know where the price or where the candlesticks on this thing went. Hold on, guys. Give me a second. Okay, there we go. Yeah, so sorry about that. That must have been a glitch. It happens sometimes on TradingView. So anyways, we don't really know if based on the covered call theory that you get 50% of the upside, 100% of the downside, we don't really know if this thing's going to go down over time. I will say that we're closer to the end of the Fed hiking cycle than we are at the beginning. And once the Fed has cut rates at least 2/3 of the way down, typically the markets bottom out traditionally and stocks move up. But like we told you guys before, we think that the bear market was already priced in last year because typically the way it works is the Fed raises rates and the markets goes up while it raises rates. And then when it cuts rates, the market drops off a cliff. But we didn't see that. Last year, the Fed was raising rates, but the stock market went down. So it did the opposite of what it usually does. And we saw the opposite happen this year too. So as the Fed was getting ready to slow down the rate hikes, the markets started taking off to the upside. And we think that the markets are going to stay flat and or go up as the Fed cuts rates, which would be the opposite of the historical norm. So with that being said, we are expecting the underlying index, which is the S&P 500, to go up in basically the rest of the year and also in 2024. So anyways, we hope you all enjoyed this content. Please like, comment, and subscribe. Let us know your thoughts down below, what you plan on doing, whether you hold any shares, whether you're bearish, bullish. Just let us know. So anyways, we'll see y'all later. Peace.